Now we're going to try to fully understand how firms make choices. We're going to look at how they make choices in the short run and how they make choices in the long run. In order to do so, we're going to assume that firms try to maximize profit. Now this becomes an issue because when we talk about profit as economists, we're talking about economic profit, which is total revenue minus economic cost. And the economic cost, the word economic is the key here, because we want to include the opportunity cost of the inputs used in the production process. So we look at both explicit costs and implicit costs. Let's look at an example. Here's an example of a business venture where we're going to look at the economic cost versus the accounting cost. Suppose there's an explicit cost where the monetary payments for labor, capital, and materials is $10,000. Now an accountant would say that's a $10,000 cost. An economist would say that's a $10,000 cost. Now the difference is the implicit cost that we look at, which is the opportunity cost that doesn't involve a monetary payment, an actual payment that can be tracked. Implicitly, we are also paying the opportunity cost of the entrepreneur's time. Whoever the manager is, or the owner of the business, could be doing something else, earning maybe $5,000. Now that's actually a cost, but it's not an explicit cost or a monetary payment. There's also the opportunity cost of the funds being used to make that $10,000 payment for the accounting cost. So an economist would say, not only are you paying the $10,000 of the explicit cost, but you're also paying the $5,000 opportunity cost for the entrepreneur's time and the $2,000 opportunity cost for what you could be doing with that $10,000. So your total cost, your economic cost, is $17,000, whereas an accountant would only book a $10,000 accounting cost. We're going to look at economic costs when we look at costs that business owners and entrepreneurs are using to make decisions.